Hi friends, good morning and welcome to my channel. Today we are going to look at a very interesting topic, that is capital structure. Hope your brains are fresh and please listen attentively. What is capital structure? Let's break this capital structure into two words and let's try to explain these words individually. What is a structure? Tell me, what is a structure? If I ask you, what is the structure of a building? What you will say? The building, it may be a two-storied or three-storied building with 3 bedrooms, a hall, kitchen and a dining. Right? What it means, what are the components of that building? Structure is nothing but the components with what it comprises of. Components. Now, what about capital? You all know capital is a long-term source of fund. Yes, a long-term source. What are the types of long-term sources available in the market? Generally, equity, preference, and long-term loan, that is called debt. If I ask you to raise 100 crore capital, how you will raise? What are the options? You can raise through equity, preference, or through debt. Okay, now let's see the characteristics of these three sources from cost, risk, and control perspective. First one is equity. The cost of equity is higher. Why? Because these equity shareholders takes the risk of loss. They are taking the risk of loss. So generally, any person who is taking risk expects much higher return. Risk is high, cost is higher. Now what about risk? Here the risk, we are looking from company's side, company's perspective, not from equity shareholders perspective. So here the equity shareholders are taking the risk. So for the company the risk is low. Now what about control? Because further issuance of equity to raise capital will lead to dilution of control, because equity shares has voting rights. It leads to dilution of control. Okay, next, preference. What about cost? The cost of preference funds is lower when compared to equity, because the risk is medium to the company. Why? These preference shares generally have a fixed amount of dividend, a fixed amount we need to pay, and generally they are cumulative. It means whenever the profits are not available, these preference shareholders has to keep quiet, but their dividends gets accumulated, and whenever during the next years sufficient profits are available, their dividends needs to be paid before equity shareholders. That means there is a risk. What is risk? We are talking about risk always. You get this doubt. What is risk? Risk is nothing but getting insufficient profits or losses, and risk is nothing but inability to pay commitments on or before due dates, right? This is called risk from the company's perspective. So for preference, even in the years of loss, you need to pay. May not be in that year, but in the years of profit, their dividends gets accumulated. So there is a risk to the company. there is a burden. Yes, the risk is medium. Because there are only three sources of funds we are explaining. We are having three kinds: high, low, and medium. But truly, what is medium is no one can define. But for our comfort, we are writing this medium because when compared to equity, the risk is higher. But when compared to debt, the risk is lower. To state this for our comfort, I have written here medium. Next, the preference. There is a risk for the company. So, there is generally and a lower risk is taken by the preference shareholders. Their risk is less. So, generally, they will get a lower return when compared to equity shareholders. So, here the cost is also medium. Return, I said, that is from preference shareholders' point of view, but their return is a cost to the company. Next one is control. By issuing further preference shares, there is no dilution of control. Okay, now debt. This is the last source. The risk to the company is higher in case of debt because it has to pay fixed amount of interest. You are legally bound to pay on or before due dates. So, in case of loss, in years of loss, that is an extra burden to the company. So, it is called risk. Okay, they are not taking any risk. Company is taking risk. When they are not taking any risk, when they are in 100% secure zone, generally they deserve a lower return when compared to other two sources. So the cost is less. And there is tax benefit also on this interest cost. Okay, next one, control. For debt, if you raise debt, if you get a loan from the bank, will it dilute any ownership? No, there is no dilution in this case. This is all about the first word, capital. Now let's join this and see what is capital structure. Structure is nothing but components, and what is capital we explain now. What is a capital structure is nothing but if I ask you to raise 100 crore capital, how you will raise? Through equity. You have the options to raise 100% equity, 100% preference, 100% debt, or equity plus debt, or equity plus preference, or preference plus debt, and the last one you can mix all the three: equity plus preference plus debt. These are the options available, and your capital structure contains any of these mix. Then you will get a doubt in what proportions we need to mix. Is there any standard mix which suits the company all the times? There is no predefined capital structure which works for all the firms all the times. There's need so there is a need of a finance manager. So finance manager, don't think he's another great person. That's you. You are the finance manager. Okay, step into the shoes of a finance manager and listen this topic. You will feel this is very interesting. You need to design the capital structure for a company. Okay, while designing, before designing, what you have to keep in mind as a finance manager, you should design the capital structure of a company in such a manner the cost should be less and the return for the owners should be maximum. This is called the optimal capital structure. Okay, our aim, our objective is lower cost of capital and higher return to the owners. While designing the capital structure, we need to keep in mind the following principles: the cost principle, risk principle, control principle, and the last one is flexibility. Okay, first one is cost. Let's take that the same example. If I ask you to raise 100 crore capital, then how you will select? Which source you will select? Let's check this table. First one about cost. Okay, scan this table. Cost, this is high, this is medium, this is low. You may say I will go for 100% debt, but you can go. But what about risk? The risk is higher, so it may not be a great decision. Next one is risk. Okay, again, let's see this table. Risk, this is low, medium, high. So you may say I will go for equity because the risk is very low. Yes, the risk is very low, but the cost is high. That is also not a great decision. Now, what about control? Let's see this table. So there is a dilution of control. No dilution, no dilution. Can we select any of these two? No. If you select this option, the risk is higher when compared to equity. If you select debt, in control, there is no dilution, but the risk is higher when compared to both these two sources. That is also not a great decision. So what we come to know is each source has its own advantage and disadvantage. And moreover, when it comes to debt, the cost is lower. This is the cheapest source of fund. Can we use heavier loads of debt? Debt is also known as leverage. Whenever our company is earning higher profits, generating much cash flows, till then usage of debt is highly beneficial. But it's like playing with fire. If the situations change or if there is an adverse business position and our firm suddenly moves into losses, when there is a short decline in our sales and our cash flows, then you will see the real pain. In those situations, you need to pay interest on these funds compulsorily. it's a defined commitment and you are legally bound. There is no permission at all, and there is no way to escape from this without any excuse. But till our firm is getting huge profits and in a rising stage, if you don't use debt, you will lose because it is the cheapest source of capital. This is like playing with fire. Just with a gas cylinder you can cook, but if it blasts, it may cost your life. In the similar way, till the situations are good, better use of debt is highly beneficial. But in case of any adverse situation, heavier loads of debt may lead to bankruptcy of our company. We have to keep in mind these factors about debt. The next one is flexibility. Flexibility is nothing but when designing, we should keep in mind that if in future I want to change this capital structure, is it possible without much pain, without much discomfort, without taking much lag? So you have to keep this flexibility in mind while designing a capital structure. How to design a capital structure? What proportions of debt, equity and preference we have to use? Tell me that. You will ask this question because you stepped into the shoes of a finance manager, so definitely you will get this question. But before moving further, let's see about the profitability statement once. Now, the profitability statement. The profitability statement starts from sales. Sales minus variable cost equal to contribution. Contribution minus fixed cost equal to EBIT, that is operating profit, earnings before interest and tax, minus interest, which is a fixed commitment, that is interest on long-term debt or any debt. Next, after taking interest, we will get earnings before tax. From earnings before tax, we need to deduct the tax portion, and after that we will get earnings after tax. This earnings after tax needs to be shared by preference shareholders and equity shareholders. First, preference is given to preference shareholders, so preference dividend needs to be deducted from this earnings after tax, and the remaining is the earnings available to equity shareholders. This is the profitability statement. Now, the question is, what proportions of debt, equity and preference we have to use to design an optimal capital structure? Okay, I am coming to that point. Listen carefully. First, you have to list out the possible alternatives in your hand. This is like trial and error method. As I said you earlier, this is like solving a puzzle. You can say, I can raise any amount of debt, any amount of equity, any amount of preference, but is it practically possible? No, it's not possible practically. As we said earlier, the capital structure is unique for each and every company, and it depends on the circumstances of the company. For example, you need to raise 100 crore capital and your firm is just a startup. If you go to the market or if you go to a banker and if you ask for 100 crore debt, will they give you? They may not give you. Okay, and next one is, for example, you can raise 50 crore debt. Finally, you decided. Again, will you get the 50 crore entire debt at the same interest percentage? Your friends may give you at 8-9%. Some other person who is ready to give, who is willing to give, may feel that he is taking some more risk. So he will offer you at 12%. That means even you are raising 50 crore debt, it may not be possible to raise the entire debt at the same percentage at lower interest cost. Okay, that means some portion of debt, say 10 crores at 8%, 20 crores at 10%, and the remaining 20 crore at some 12%. Now, remaining 50 crores. In that 50 crore, say 40 crore through equity and 10 crore through preference. What are your alternatives? You have to note it down. You ask each and everyone, go to the market, go to the bankers, talk with some other people and decide among these alternatives which one is better. You have to select. And if the company progresses and after passing some days and your company is earning much more profits and our business is growing on, again there is a need to change this capital structure. And if your business is growing heavily, then everyone run towards you. I will invest in your company. I will invest in your company. I will give you loan. I will give you loan at this percentage. Everyone come towards you. But in the initial stages, it is not possible. And if you want to raise further debt, the new lender will see your position and he will think there is a heavier debt portion to this company. This means this is a little riskier. As I am taking risk, I will increase my interest rate. After certain portion of debt, you won't get benefited through debt. The another angle is the psychological aspect of shareholders. The shareholders look at your company's position, and if they feel there is heavier debt, then they feel it's riskier and they will sell your shares and your sale price will drop drastically. That means you have to see what are the possible alternatives in your hand and you have to select one among them. Now, the other factors we need to consider are, first one is leverage effect or trading on equity. Next one is coverage ratios. We have to check the interest coverage. Next one is cash flows. And next one is about the overall cost of capital. Let's see what is leverage or trading on equity. This leverage or trading on equity is nothing but if we use debt, it is risky. But if you don't use debt, you are losing the benefit of higher return to your owners, that is equity shareholders. If you take care of the coverage ratios and cash flows, you are in a secured zone. You can make a great benefit from the use of debt. Let's see how. You have to raise 2 lakh capital. There are 3 alternatives. In first alternative, there is no debt. 2 lakhs we raise through 100% equity. Second alternative, 50% debt at the rate of 10% interest, 30% preference at the rate of 12% dividend, remaining 20% through equity. The third alternative is 80% debt at the rate of 10% interest and the remaining 20% through equity. The expected EBIT is 50,000 rupees per annum. and the share face value is at the rate of 10 rupees. Now let us see these three alternatives and select which one is best. Why we are doing this is to prove usage of debt is beneficial. Let us see. First one is about EBIT minus interest. EBIT is 50,000, the expected EBIT. $50,000 and $50,000. Next one is interest. We have to deduct interest. In first alternative, there is no debt, so no interest. In the second alternative, 50% debt means in 2 lakh, we are raising 1 lakh through debt. That is 10%. On 1 lakh, 10%, it is 10,000. And in third alternative, 80% debt means in 2 lakh, 80% means 1,60,000. On that 10% means 16,000. This is the interest portion. Now EBT is here 50,000, and next 40,000. $34,000. Now let's assume the tax is 50%. So now earnings after tax is 25,000, 20,000 and 17,000. Next one is preference dividend. In the first case, there is only equity, there is no preference, so preference dividend is 0. In the second case, 30% preference. In 2 lakh, 30% preference, that comes to 60,000. On that 60,000, 12%, 7,200 rupees. And next one is third alternative, there is no preference, so it's 0. $25,000, 800 and minus 2. This is earnings available to equity shareholders. Now we have to divide these earnings with number of equity shares. In the first case, 100% equity, 2 lakh rupees we raised through equity. The equity share price is 10 rupees, so 20,000 equity shares. Here 50% debt, 30% preference and 20% equity shares. 20% equity shares in 2 lakh, 20% comes to 40,000 and 40,000 divided by 10, 4,000 equity shares. And the third case is 20% equity. In 2 lakh, 20% comes to 40,000 and the share is 10 rupees, so 4,000 shares. Now it is 1.25, here 3.2 and 4.25. See, the third alternative gave equity shareholders a higher return of 4.25 rupees. This is the better alternative here. What we are trying to prove is with the use of debt, the equity shareholders and the company gets benefited. The next thing is we need to check the interest coverage ratios, because we need to pay interest compulsorily, because we are legally bound to pay that. There is no excuse for non-payment of interest. So what is interest coverage ratio? EBIT by interest, that is earnings available for payment of interest. Here there is no debt, no problem. Now EBIT by interest comes to 5. 5 times your interest is covered by EBIT, by earnings, operational income. Now 3.125. Here 3.125 times your EBIT covered the interest. Any ratio more than 1 is good, but if you cover interest more than once, that is 3 times, 5 times, it is better, and you are in a better position to use debt because you are getting cash flows. The next thing is cash flows. This is a better option, but you have to check, is your business able to create stable profits, or your profits will widely fluctuate. If your company is doing a business which cash flows and profits widely fluctuates, or it is seasonal, then it's a better option not to go for heavier loads of debt. But if your company, if your business is generating consistent income, consistent cash flows and profits, then it's better to go for heavier loads of debt, because when the cash flows are consistent, you are in a position to repay the interest amount without any failure. We have to keep in mind the interest coverage ratio. The next one is cash flows, the operating income, and the last one is the overall cost of capital. The overall cost of capital should be minimum. Even you use equity, debt, or preference, these are the factors you need to consider while designing a capital structure for a company. There are some theories like net income approach, net operating income approach, Modigliani-Miller, and the fourth one is traditional approach. We will see about these approaches and these 4 methods in our next videos. If you like my video, please give a like, share it to your friends, and don't forget to subscribe. Let's meet in the next video.